Bench just went out of business, leaving thousands of business owners abandoned going into 2025, where they were relying upon Bench to do their accounting at a high level. And so now I believe it's more than just that Bench went out of business. I think there's a greater conversation to be had here because of how big Bench got and how important they were to their clients before they went out of business. I brought on an expert in accounting, owner of a company called Ledge, Ryland Beard. Ryland, thanks for coming on and helping us with this conversation.
Thanks, Sean. Good to be here.
So please, for everybody who does not know you yet, because the internet is wide, tell us more about yourself, your life at Ledge. What can we know about you?
Yeah, sure. So I started this company. We're a niche accounting firm specializing in very specific industries. So what we do, which is a little bit different than most firms, is we're a full service bookkeeping and tax firm. So in a way, we're similar to Bench, but much more tailored and much more specialized.
Okay, so you have customers that are like kind of like the same type of consumer profile that Bench had.
Small business owners. Yep.
Okay, cool. All right. So sounds like you'd be well enough positioned to tell us kind of what happened at Bench. And I think that's what a lot of people on this live stream or who tune in later will like to know. So what happened with Bench?
Yeah. Well, the first thing I think is important to note is when you create an accounting firm, you don't need a lot of money, right? Like I started my company, I didn't have any money. I had a MacBook and that was pretty much it. Bench did it the opposite way. They raised a lot of money and then created the product after. So when it comes to accounting, it's very much a knowledge-based industry. You have to know what you're doing. You have to learn accounting. You have to study, of course, and then you can offer your product to your first customers. And if you're successful, the market will reward you and say, great, let me tell my friends, right? And then you can grow a business from there. Bench did it the opposite way, which in my opinion is a bit of a mistake. Raise money, big idea, and then back in to a product based off of kind of a cool brand and marketing and things of that nature. And when you're going backwards, you're not product focused. And we all know the best companies in the entire world focus on the product and then go from there. Product first. It's always that way. The product must be first, or the service in this case must be first, and then you can move forward. So with Bench, it seems to me that they went under because the product wasn't there. And when I talk to, some of our clients that have switched from Bench to, our service, what I hear is pretty consistent. The devil's in the details, right? So it's all communication. I didn't get my financials on time. I didn't feel comfortable. My financials weren't accurate and things like that. So, it's not rocket science, but I think that the reason they probably didn't work out is because of, the lack of focus on the actual product that the customers are receiving on a monthly basis.
Okay, so it sounds like they kind of did your typical tech startup thing, right? Like, we've got this idea, we want to get big, we're going to raise a bunch of money, figure it out along the way, kind of thing, right?
100%.
Yeah, and so I think what I caught, because I saw a bunch of Bench ads, right? I saw that it was kind of this utopian kind of thing, like we'll do everything for you, right? Like come join us, it's going to be great. And it leads me to believe that I think from a consumer side, that the things that I found dangerous about Bench and what I think there could be a greater conversation about is the element of advertising to people who don't know anything about accounting and then making claims, right? That they can offboard all this stuff and it's going to be simple and you're in control because we know what we're doing and we're going to provide you this software or whatever. It seems pretty predatory to me, right? If I was going to sell somebody a product that also required you to know what you're doing to some degree, like to sell you a car, it's implied that you have to have a driver's license, right? But with accounting, a lot of very small business owners who are on Facebook and seeing these Facebook ads, they may never have touched accounting a day in their life, and they know what their bank account is and don't run out of cash. Maybe they might know those principles, but they don't know how to work with an accounting firm or do their taxes, or they don't know what a ledger is or how to enter onto a ledger. So I find like it's predatory in nature to make those big claims through an ad campaign and grab a bunch of people who don't know what they're doing, right? And then I think you mentioned in a private conversation about the talk that their software is proprietary, and I think to take somebody who knows nothing about accounting, knows not that they could use something like QuickBooks, and then put them into something where it's just Bench's stuff, I think that's really dangerous. And I don't know anything about Bench's proprietary software, so it'd be really cool if you rip on that too.
Yeah, sure. So in regards to the software, the theme, and this is kind of more of a tip, but you got to own your own data. It's crazy. I mean, the idea that you would just give all your data to Bench or any accounting firm. By the way, it's not just Bench. I see this happen time and time again with our clients. The accounting firm will say, hey, we'll create this QuickBooks or whatever for you, or our proprietary software in Bench's case, and we will take care of your accounting. And you don't have to pay a fee. And the client's like, oh, great. That's amazing. I don't have to pay a fee. Great. And then, they kind of give this away. And then all of a sudden, if they want to switch, it's almost impossible, right? Because you're in a way handcuffing yourself. So the biggest thing, own your own data, know your own numbers, know your own P&L. And if any accounting firm is wanting to help you, amazing, great. But you should own your own accounting data, which in most cases, that's QuickBooks Online. That's, QuickBooks is by far the biggest vendor, but there's also smaller ones out there as well. The biggest point is when it comes to Bench, you gotta own your own stuff. And if Bench is saying, trust me, that means you probably should not trust any company like that.
So I guess if there's a quick tip for business owners at this point, right, where they could use a third-party accounting company like Bench, Ledge, whatever, but you say own your own data, like what is step one for somebody who just runs everything out of their back pocket?
Yeah, good question. Step one would be find the accounting software of your choice, right? And that depends on what industry you're in. There's a few different kinds. As I mentioned, the primary accounting software is QuickBooks Online. I think some crazy stat, like 90% of business owners use QuickBooks. You don't need a fancy QuickBooks. In most cases, you just need the very, very most basic model. And what that looks like is you're the master administrator on your account. So in QuickBooks, you can add an accountant, but they can't take away your ownership. So if anything happens, you simply delete the firm, right? And then you hire someone else, but you are the owner of that data.
Okay, cool. Yeah, I teach the same thing in concept in co-hosting, right? So I've got students who do Airbnb, that's this channel, and then people start co-hosting and they let the owner own the listing and own the cash flows and stuff. And one of my students ended up getting like grifted by an owner out of like $40,000 or $50,000 of fees, where he's supposed to get paid like a wage or a profit share to run the properties. But since the owner owned everything, the listing, the revenues, how the bank accounts, he would send an invoice, but he was doing all of this legwork at these properties, paying housekeepers and stuff every day. And the guy just ended up not paying him. So I said to my students after finding this out, no more will we ever let an owner control everything. We need to create the listing as the Airbnb expert and at least control where the cash flows, where we can put it into an account and then maybe do a real-time split or pay them a check every month. But since we're not in the power seat, we don't have as much control. We can't be giving them everything. It's kind of a different topic, but in the same way, if you give everything away and you have nothing, then yeah, you're the most vulnerable. You're the most exposed. It's really kind of
100%. Wild. And I think the biggest thing there as well is just to think long term. I think sometimes it's really easy to make kind of a quick decision, but whether it's your example or whether it's accounting or whether it's Bench, like think about what could go wrong, and if things do go wrong, where are you at? And I think if more people thought that way a year ago, when they were using Bench, they might not have been in such a kind of rough situation as they are right now.
Yeah. So Bench, I claim, is predatory. The fact that they're running ads to know-nothing people, trying to get them to be your first accounting firm, right? They're going for this blue ocean of people who never thought they needed an accountant. Then they're proprietary in the fact that they've got these softwares that like take control of everything. And then now that Bench has gone out of business, people don't have the ability to just pivot. Like you just said, you can't unplug one accounting firm and plug in a new one to just do as Bench did, because everything was proprietary. Now, in a way, they're screwed. I feel like, and in another way, these people, even if they knew something about accounting, they didn't see this coming. Business owners didn't see this coming. And I believe it's because they overpromised, right? They said that, we're this great company, well-funded, we'll do everything. I think it created like an unnecessarily trusting environment. Like it was irresponsible how much trust they were trying to get from their customer base, in my opinion.
Definitely. Yeah. And I think to go back to the predatory comment, I've seen reports of Bench in their last week of business. This is absolutely mind-blowing. Ask for a full year in advance payments for 3 or 4 days before they closed. And I've seen this from quite a few of their clients. Thankfully, not that many people paid because they weren't that happy with the service. But the fact that some people paid in a year in advance to then find out less than a week later that they just paid a company who's no longer in business is crazy. In regards to the over-promising, yeah, 100%. I mean, they promised the world, they delivered nothing. So it's really disappointing for their customers.
That's wild, because if you think about it, the companies do this all the time, right? They're short on cash. They could either try to raise more debt or equity, or they could try to get their customers to fund them by creating terms like gift cards. Remember that gift card fiasco where I think Minnesota was the first to pass the law where you weren't allowed to spend you weren't allowed to charge down the balance of a gift card through service fees.
Mm-hmm.
And it ended up locking away millions and millions of dollars into gift cards. That the money's still there, but companies can't go access it. But people would use gift cards in the same way. If you sold, $500 million in gift cards for Starbucks, Starbucks has that liquidity. They become the bank, and predatorily, people were taking advantage of that and then going, well, if you inactive gift cards, we charge 50 cents a month or $2.50 a month on the card and just deplete the cards over time. And they had to pass legislation to protect customers, right? Obviously, we're in a different world here. This isn't apples to apples, but we're seeing stuff in crypto with the Hawk girl, the crypto crash thing right there. And we're seeing like gift cards just the same. And now with companies like this, where you sign on somebody who knows nothing about your service, and they give away, like the companies could go out of business by over-reliance on accounting firm markets, right? So, I mean, there has to be controls one day where a company can't like do this and then go, hey guys, please pay us for a year of service because we're out of cash. They didn't have to disclose that. And out of all the kind of companies on the planet that should tell you that they're having a cash issue, it should be your accounting firm, right? Out of all the people, they should know how to manage money. The fact irony that they didn't have to disclose it is actually theater to me.
Yeah, the irony of that is crazy. If only they hired a good accounting firm to do their own books, maybe they wouldn't have been in such a bad situation. I found myself thinking, when it happened, like in a hypothetical world, like what would I do if I own Bench and we're a month away from bankruptcy or at least like closing the business? I feel like you just got to have that Steve Jobs type of person, come in and say, everybody's gone and here's what we'll do. And here's the plan moving forward. But I don't think they had that. And it seems like they couldn't agree on that because there were so many hands in the pot with all the rounds of, investments that they raised.
Yeah. So tell people layman's terms, what happens when you raise money? You just talked about the chefs in the kitchen effect of raising money.
Yeah. So, I think what happened with Bench specifically is you had some people promise an amazing idea, and they probably took a little bit of money off the table. I would imagine the founders did. They raised this money in hopes of being a company that they ultimately were not, but they wanted to promise kind of, hey, we are the future of bookkeeping. We are the future of accounting, and we will replace, or revolutionize, I think is the word that they used, what modern day bookkeeping looks like. So investors said, yeah, I want to be a part of that. And they ended up writing checks for what amounted to over $100 million, which for some companies definitely makes sense. But for bookkeeping companies, there's, as I mentioned before, like there's not a lot of costs, right? It's not like a Starbucks chain where you have to put down a lot of money to be able to open a new cafe. For bookkeeping, it's not that way. You should grow and then you should hire. Or you should hire and then grow, but it should pace with one another. And with Bench, it didn't do that. They hired 650 people, and they only did 12,000 businesses, which amounts to about 20 or so, check my math, but about 20 or so businesses per employee, which makes very little sense if someone's charging $300 a month. So anyway, well, sorry, long answer. I went on a bit of a tangent, but they raised a bunch of money and it didn't work out.
Well, you're speaking to something that's really funny, right? Because they try to do that growth thing where we're like, we're going to hire to scale, hire and train all of our people, and we're going to rely on our ad campaign to bring in enough businesses. And they never got enough businesses for the rate of growth that they were anticipating. And to bring it full circle to what you said, the $100 million that they raised, those investors wanted their money back, right? So they're like, you need to get to scale so I can get my return. And so they tried to swing the bat, for the fence, right? We're going to hire the staff to do the load that we promised. And maybe hiring all those people was them posturing to their investors like, yeah, we'll do it. We got this. We're hiring the people. We're ready. Everything but the customers came. Right? And
Yeah, that's a great point. I think that's exactly what happened. And like, I actually think their marketing was fantastic. I mean, like the brand, the look, the feel, the logo, the colors, like everything kind of just fit. And I think their ads worked really well. The issue, I think, was retention. Like people got on board, but they didn't stick. And unfortunately, you know, for them, like you can't operate a business, especially one with a recurring business model, if everyone's dropping off, you know, after a couple months of service.
Yeah. So anybody who's tuning in now, since this is a live stream, I'm on air with Ryland Beard, the owner of a company called Ledge. He was a competitor of Bench's before Bench went out of business. And the fact that Bench went out of business, I think, is a big deal because business owners out of nowhere were stuck, stranded, having given all their power of accounting away to a company that said, trust us. And then they disappeared. And so today we're talking about why Bench went out of business, how it's dangerous to business owners. And Ryland's about to tell us some tips, given the fact that we could trust an accounting firm and they could just disappear like any other vendor off the planet. Ryland's going to help us prepare for the absence of a business like Bench. So that way we can continue if somebody who we work with dies one day. And a story, reason why this is actually kind of important to me, I immediately thought of Ryland because Ryland and I used to live together at this high rise in Dallas at one point. And, you know, we would talk at the coffee shop about business and stuff. And I remember Ryland, I think I told you this story too, when you told me that you do accounting. I had a mentor when I was a teenager. I was in the Big Brothers Big Sisters program, you know, where they let poor kids hang out with like successful adults, kind of successful adults. My mentor was a business owner. He had a carpet cleaning business. And at 16, I was cleaning carpets, right, working for this guy. And one day, his accountant stripped $35,000 out of his bank account and disappeared, right? And he was too busy trying to manage the fact that he had zero cash. He could not make payroll to pay me, for example. He couldn't re-up on supplies. He was so stuck trying to survive that situation that he didn't have the wherewithal to go hunt down this lady and find her and the money. I think she got away. You know, he tried to press charges, but they really never got her. And he almost went out of business because he trusted an accountant. And that was one of the real life scenarios that catalyzed an educational experience I had when I was homeless in 2009. I snuck into entrepreneurship courses, and the guy that I was watching had a seminar on cash, or a semester. So it was actually a regular college course. So it wasn't a seminar. He did a semester on cash, and it was all around rule number one of cash, which is don't run out of cash. And immediately when he started talking about that, and I'm like hiding in the back of the audience, you know, with all these students who actually paid for the program, I remembered the day that my mentor almost went out of business because he got robbed. Accounting is a huge thing. Cash is the most important part of a business. My personal story, a lot of you guys know, I started an Airbnb business with like $5,000 and launched a couple of apartments buying used furniture. And I've made over $10 million since by managing my cash well. And I think it's an important topic that we understand that we can trust people with our cash, especially people who claim to be professionals with cash, and they can be the ones that actually put us out of business. So big topic. So Ryland, can we, I guess, get into some solutions for some people? Like, let's say people need to start doing accounting in a healthy way on their own at home with their small business before they ever reach out to a company. Like, how do they keep their house clean, per se, before they grow to need someone like Ledge or Bench?
Yeah, definitely. First tip, in regards to your example, Sean, always give view-only access to your bank accounts, and never, for any reason, give more than that. Because at the end of the day, you know, you don't want to trust anyone, and even if it's a wonderful firm, like, things happen, and you know, you never know what someone else is going through, and if they have something happen in their life and they become a terrible person all of a sudden and steal your money, you don't want that to even risk that. So always view only everything, and trust but verify, right? You never want to fully trust anyone except for yourself and maybe your family. But as far as my tips, you know, these tips have served me really well. Some of them are straightforward, some of them are a little more complicated, but these are the fundamental tips that I would recommend to any business owner. Whether you have an accountant, whether you're thinking about hiring a new accountant, or whether you're doing it yourself, these are just kind of some general tips that you should always follow. Number one, never commingle, right? So if you have a business, it's very important that you separate your business from your personal situation. You should never be paying for your personal expenses from your business account and vice versa. Because when you do hire in the accountant, they're going to ask, they're going to say, hey, I need your business statements, or I need access view only to your business account. And if some of your business purchases are on your personal, they will never know. And the majority of accountants will forget to ask. So if they don't know, you're basically losing out on deductions. And, as time goes by, as months pass, you're going to forget about it. And they're not going to ask you. And so what that means is you're going to overpay your taxes, which is very unfortunate, but I see happen all the time. So first tip, separate your business from your personal financials. Step number 2, we hit on this a little bit earlier, but when you are ready to move on, create your financials, you want to own your own accounting. So for those of you who just joined us, this is a very important tip, because this led to a lot of customers, 12,000 business owners, to give you an exact number, with Bench going under, which is crazy. But had they owned their own accounting, had they thought about owning their own accounting, they would have been in a much better place. So what does that mean? Owning your accounting means creating your own QuickBooks in most cases. If you want to use a different platform, that's fine. But you should be the owner, the master administrator, or primary admin on your account, because you then have the power. You have the power to say, this person can view my financials, but this person can't. I don't like this accountant. Boom, they're gone. Sometimes accounting firms will be a bit predatory, because they will say, hey, Sean, listen, man, I'll do your accounting. And guess what? You don't have to worry about getting your own QuickBooks, because I have a special discount and you can use it through me. So that should be a red flag for you, because at the end of the day, if you ever wanted to switch, you're in handcuffs. They should give you access, right? But they don't have to, and they're going to make it very painful for you to switch. So by owning your own data, you circumvent that, and it's never a problem.
I think that's actually a big one to sit on, let people absorb for a second.
Sure.
Companies will say, we can get you QuickBooks for cheaper, business benefit, and you should actually be like nervous about that instead of running for some whatever discount. You should opt to spend more money on the software, because then you have full control of said software. That's a big deal.
It is.
Are there resources for people to learn like the super basics of like QuickBooks, like how to link it to your bank account and stuff like that? Are there online free resources you think people can use?
There are. Yeah, there's plenty. YouTube, I think, is probably the best bet.
Here we are. Yeah.
Here we are. So I think, just look up, find that search bar, and just learn. Which is a really great point, and something I'm glad you brought up, because whether you do your own accounting or you hire it out, it's important to learn, and if you can spend 10 or 15 minutes on a YouTube video and train yourself, maybe you don't know everything about QuickBooks, but at least the very basics, you'll know the right questions to ask. So I don't even think you need to go and, if you're listening to this, go do a course. I don't even think that's necessary. Just a few YouTube videos will give you kind of a basic understanding of accounting. And by having that, you're equipping yourself with the right questions to ask.
Somebody actually had a question about updating CSV files. They want to know, how often would you download data or a CSV file to ensure your data doesn't get lost if you're using the software?
If you're using a company that uses proprietary software, I would say all the time.
I guess in this case, if you're like, for a company like Bench, you would have hoped you did it daily, right? That would have been important. But then like for something like QuickBooks, they're pulling from, well, I guess you have a manual uploads in QuickBooks, and then they also scrape your bank account, right? So is there a need to do like downloads into database information?
Not necessarily. Not if you're the owner. So if you're the owner, you're good. If you're not the owner, then I would download it, all the time. The way QuickBooks works at a very high level is you can either import your bank data, or you can synchronize your bank to where the transactions automatically flow through a provider called Plaid. So Plaid basically just connects QuickBooks to your bank, and then you see the transactions and you can categorize them.
That's super cool. Now, will the government take those synchronized transactions as receipts then, or do you still have to have receipts for things?
Receipts are always advisable. I see a lot of people want to put their receipts in QuickBooks. You don't actually have to. Sometimes receipts are a bit of a pain in QuickBooks and they can produce errors. So what I tell our clients is, excuse me, just take a picture. All you need is a digital copy. You don't need to save paper. Sometimes I see people with like massive manila envelopes and like all their receipts. That's not necessary. Just take a picture. These days you buy something online, you automatically get the receipt emailed to you the next day or in a couple minutes after. So you don't need actual physical receipts, and you actually do not need to keep those receipts within QuickBooks.
Okay, and so let's say somebody had a lunch and they're like, we talked business at this coffee shop or this restaurant.
Yep.
Do you need to keep that receipt, or could you notate the plaid synchronization where it said, Le Monde coffee shop or whatever, and it was like $80? Could you say, notate this was lunch with person in QuickBooks without needing the digital receipt?
You could, however, okay, it's best advice, take a picture just in case.
Okay, cool.
Yep.
So, but I guess that does probably, I think a lot of us feel overwhelmed with tracking expenses going, gosh, I can't take a photo of absolutely everything in real time. Like you're cleaning a toilet and you're out of Clorox cleaner and you have to go to CVS next door and just buy some Clorox to clean an Airbnb in time. And you're just, your brain's scrambled and you're like, I didn't have time to take that receipt or whatever. So I think a lot of people feel overwhelmed that they can't capture every transaction.
Yeah, so, that's a good point. So I think it's $75. Someone can check me on this, but I think if it's under a $75 threshold, a receipt's not needed.
Cool.
So that's like 80% of these little kind of random transactions.
Nice. So you could just declare what it is, say, I bought this, not necessary.
Exactly. Yeah.
Airbnb hosts are going to love to hear that one. That's great.
Yeah. Double check me on that amount, because I think it does change a little bit, with inflation. But I believe it's 75 without looking it up.
So now the fun part, like my ADHD brain is going, like with a place that's a restaurant, right? And the bill is 150. The receipt would show what you ordered, right? But it's advisable because let's say like even drinks you can write off as an entertainment expense, right? So if you stated that the lunch was entertaining a client, then what you bought like doesn't actually matter because anything would be write-offable, right? So a receipt sometimes is needed to show that you bought like furniture and fixtures at Lowe's. Like I bought lumber or hardware at Lowe's and I'm claiming it as an FF&D, right? So you might need the receipt for a $400 purchase for like a chandelier. But if you bought $400 of energy drinks at Lowe's, that would not be a write-off for FF&E. So that's why they would need the receipt. But for the restaurant, you say this is an entertainment expense, the receipt by nature may not be necessary.
Yeah, that's exactly right. What I advise our clients is avoid the word entertainment. So when I say that, what I mean is refer to meals as meals. Meals would include, drinks. It would include maybe some cocktails, maybe some water, but like it wouldn't be comparable to like attending a Mavericks basketball game. That would be entertainment, right? And so entertainment is not necessarily deductible, but meals, if they are business meals, are. So just a little discrepancy there, but it does make a bit of difference because we want to always include meals because they are deductible.
So entertainment, so as I say, sales activity. So like taking a client out to dinner as a sales activity could be just a business meal, like business meals, sales activity, something would be the line item there.
Exactly. Yeah. So we would consider that like, marketing meals. But if you say, hey, client, or hey, potential customer, like here's a couple tickets to a game, that might not be deductible because it could be considered entertainment depending on what, you're actually doing.
Yeah, I guess you'd have to find a way to argue cost of sale there.
Yep, exactly.
That's fun. Cool. Well, thanks for going into a little bit deeper detail there, because I think a lot of us small business owners are super overburdened with the individual line items, like how do we track $4 here, 50 there. So it's really empowering to know. It's great. So so you gave us a couple steps, which is to own your own accounting and to not commingle. So just have a dedicated business bank account with its own debit card, right? It's easy to own two different debit cards, right? And then so after that, did you have a step 3?
Yeah. So the step 3 is really just educate yourself, at least to a basic degree, because the more you can learn, the better. For instance, what if I had to ask myself, what are the top couple of things I should know as a business owner? Okay, what's a P&L? What's a balance sheet? Balance sheets for your audience especially are very important, because if they're buying properties and maybe fixing them up or Airbnb-ing them, like they need to track that as an asset. So what is a P&L? What is a balance sheet? What is a cash flow statement? If you know the answer to those three, you will be in a great position. You will be in an amazing position.
Okay. Do you have a book recommendation, like a low-level book recommendation for newbies?
I got to keep coming back to YouTube. I don't mean to sound like a broken record, but I feel like, sometimes with books, you can kind of keep going and going and not get your answer. But I feel like with YouTube, you can really find what you're looking for. Also with ChatGPT, I mean, it's a phenomenal resource for going back and forth. I wouldn't disclose a ton of personal information there, but when it comes down to finding out exactly what's on your mind, it's a great resource.
No, you're right. Like I've read, I'll say I'll read 10 books for every one that actually gives me something real. So you're right there. And then with ChatGPT, you could say, I know nothing about accounting. I just started a business. Teach me accounting step by step.
Yeah. And you can also ask questions, which you can't do with any books, obviously. So being able to like quiz yourself by saying, prompt me by, or prompt ChatGPT to quiz you on the recent knowledge that you've just discussed. And also being able to ask for different pieces of information, which are questionable. Like that's amazing. And definitely something I take advantage of a lot.
Yeah. So we have a question from a guy who does like more than $1 million a year on Airbnb. His name's Monish, and he's got multiple properties and he does co-hosting. So they're not all his properties, and he buys stuff for different owners. I guess his question is about assigning expenses to multiple properties easily while still trying to like maintain his momentum as a busy DIY guy.
Yeah, that's a fantastic question. I'm really glad we were asked this. The best way, depending on how many properties, I would say less than 10, I would do QuickBooks with classes. So that's one QuickBooks account. Each class would be the location. And then that allows you to essentially just be able to say, okay, this expense was for property A. I'm going to put property A's expense on this P&L. And so what that looks like is like you have this P&L, and if you can kind of picture like left to right, you have every column is a property, and on the very right, you have the total. So for this sake, like you can just assign expenses to the right location, and then that's going to produce correct financials.
Okay. Now I'm sure he probably wants to, with one purchase, buy stuff for multiple properties at the same time.
Yeah.
And that's probably going to be an issue for him there.
It's actually not. So QuickBooks has a very little button next to the expense. It's called split. And with the split button, what you can do is you can basically apply, okay, let's say you $100 at Home Depot, 25 per property, 4 properties, you can split it out. For recurring transactions, like if you wanted to say all Amazon, I'm just making this up, obviously, but let's say you only buy supplies from Amazon and you buy about equal amounts for all your properties. What you could say is you could create an automatic rule within QuickBooks, which basically says if this expense is Amazon and it's over or under $500, we're going to apply it 25% to every property. Each property will receive, $125 in our $500 example, and then that will be automatically applied. So not only do you not have to split it, you don't even have to add it. So this is an auto-applied rule, and depending on how many properties you have and what the expense is, you can tailor all this and basically make it completely automated.
That's cool. Yeah, and I guess the only part will be maybe one owner will be kind of trying to nitpick that his expenses weren't exactly this amount of money, that he didn't pay for that much toilet paper or something, but like that's a minutia that you can't avoid at that point.
Yeah, it is. It definitely is. And on that, it's kind of the 80-20, right? This is like Paretos principle where 20% of the work is 80%. And you know what I'm referring to, but like you don't want to waste time in the minutia, right? As a business owner, it's not going to benefit you to look at a 5-cent charge and apply a quarter of a penny to one property, obviously. And so for this, it's kind of the same logic, the same thinking. You don't want to waste time. You want to make sure that you're getting the most bang for your time.
Yeah, that's really cool. Well, thanks for that. So thanks for the detour. Do you have a step 4 for people trying to DIY?
Those are my big three, actually.
Okay, cool.
As far
Right
as
on.
this isn't really a tip. This is more of a recommendation. But what I would recommend to your viewers is to not settle. Don't settle for a generalist accountant. Find someone with experience, obviously find someone with amazing reviews, but find someone that's in your industry with experience. Because if you can, if you can find that's really the future of accounting at a bigger picture. The accounting industry is not meant for companies like that. It's not meant for a general solution, one solution for everyone. Construction company is a lot. Construction company's accounting is a lot different than a restaurant. A restaurant is a lot different than an Airbnb host, right? Like these are completely separate. The only similarity is that they're both businesses. So they're accounting for both businesses, but really this is very distinct. So what you'll see in the future in the next 5-10 years is you'll see accounting firms becoming bigger, but really just specializing in one particular type of business. So if you can kind of leapfrog, and if you're a business owner now, find that accounting firm that's tailored exactly for your business, you'll be thanking yourself in the future.
That's really cool. So I want to give people a cool hack takeaway for like tax write-offs if you know some, right? I know one that it's like FF&E has a accelerated depreciation. I don't know if it's 75% or 100%, you might know, but like I know in short-term rentals, if we rent a property and then furnish it, we can write off a lot of that. Do you know what the percentage is for FF&E?
Yeah, well, hopefully it's going back to 100% next year or this year, 2025. We'll see. For 2024, it was only 60%. Unfortunately, it was very little. But hopefully we'll see that pick up. I got a lot of tax tips. It's a great question, Sean.
Cool. So for people who touch like real estate and hospitality, small business owners, do you have like 4 other big write-offs that they may not know about?
I'll tell you my go-to.
Okay, cool.
My go-to is an S corp. Okay. So kind of this is kind of what I consider like the first. Loophole is not a right word. It's basically just a tip. It's simple, but a lot of times accounting firms will drastically overcomplicate this. If you are an LLC, and let's just say that someone owns 100% of their LLC and they're reaching a point where they're making like $7,000 or $8,000 per month, they should switch to an S corp. By switching to an S corp, your tax rate will drop. To get into a little bit of detail there, we all have to pay self-employment taxes on our income. Social Security, FICA, basic, Medicare, Medicaid. We all have to pay these self-employment taxes. What an S corp does is instead of paying self-employment taxes, which equate to about 10% on your total income, all you have to do is pay self-employment taxes on your salary. So when you're an S corp, you can make yourself, as the owner of the business, an employee. Therefore, you pay self-employment taxes on your employee salary. So let's say I make $100,000 a year total. I pay myself a salary of 60. On the other 40, I don't have to pay self-employment taxes, which means I save myself.
So the 40%, you can still pay yourself the 40%, but as a distribution or something?
Exactly. Yeah. So you're 60K as a salary, 40K as a distribution, and the distribution will be exempt from self-employment taxes. So you'll save about 10% of 40K. So you'll save about $4,000.
Okay. So that's like a capital gains kind of thing?
No, it's not. So that's just, that's just basically income that goes straight to your personal return, and you'll still pay state and federal taxes, but you won't pay self-employment.
Wow. So it's not even some special classification claim.
No, it's not complicated, but a lot of times accounting firms will make this like it's, just a crazy mystery. So our example was 100K, but I see a lot of clients of mine, they'll make 500,000 a year in net income. They'll make $1 million, they'll make more. If they pay themselves a healthy salary, the rest of their income will be exempt. So for example, if you make $1 million a year, you pay yourself a salary of 200, 250. The other 750 or 800K is exempt from this 10%. So then the savings really add up. If your accountant recommends you switch to an S corp status before you're making $7,000 or $8,000 per month consecutively, ignore their advice. It's not worth it. You have to be making it about 7 or 8K. So anyway, that's tax tip number one. So we hit one more.
Yeah, let's hit us with something else. That was really cool.
Right. As far as business vehicles, I know that's a good one for your audience because everybody's got to get around to their properties. You know, it's pretty straightforward in that regard. Everyone's going to have a car, and we're all business owners, or at least most of us watching are probably already set up. Next year, this is me speculating a little bit, but I think they're going to increase the 179 allowance to 100%. So we all know that if you get a business vehicle, you can expense a lot of it. What I find our clients a little unsure about is within financing. So let's say that I want to buy a G-Wagon, right? Classic example of this. I want to buy a G-Wagon and I want to consider it a business vehicle. However, I don't have all the cash to just buy it outright. I want to finance it. So let's say I finance my G-Wagon. I don't know what the payment would be, but let's just say it's like $1,000 a month just for simplicity. I think it'd be a little more, but $1,000 a month. And the car cost $100,000. I buy it in 2025. I can write off my income $100,000, even though I financed the G-Wagon. I can take my income from, let's say it was 200, it drops to 100. So I haven't spent the cash, but I'm getting the deduction.
It's wild.
It's wild. It's crazy. And so, you know, obviously you have to be careful with that. You know, you don't want to just buy a car just to buy a car. But if you are, and you can get a good interest rate on it because maybe you put up some collateral or something, it makes a lot of sense. You know, you can get a huge tax deduction without spending a ton of money.
You know, some of our students also do Turo. I do some Turo coaching for some people. Yeah, and if you buy a fleet of say 5, 6, 7 cars, and you could write off 100% of their value, like that, it's like the FF&E, the accelerated depreciation for FF&E. You're putting like in Airbnb, furniture is essential to make money. You can't take an unfurnished place and really make any profit. Turo, a car is essential, right? You could do a lease, of course, but if you could buy the car and take that massive deduction, then as you grow your Turo business, right? Let's say you make $100,000 a year net income, but you add a car to your fleet every year, you're just constantly writing off. Like if you added a G-Wagon to your fleet in this example, you could write off your entire income by growing your Turo business one vehicle at a time, and you're coming out of pocket almost nothing. That's insanity.
Yeah, that's a great point. Do you cover cost segregation much on your channel?
We've just added a real estate agent that specializes in investing in Airbnbs because I'm the guy who does arbitrage. So I'm not a real estate agent. So I don't, I'm also not a tax expert or an accountant, right? So cost segregation is something I know about, but I don't teach it. I'm sure a lot of people would like to know better about it. We've got a guy in the program who can talk about cost segregation now, like within the last couple of months, but no, we really don't teach it.
Okay. Should I give the audience like a little teaser?
Sure. Yeah. I'm not going to claim to know exactly how to do it, but I'll let you swing that bat. So.
Yeah, sure. So cost segregation, you hear that term a lot, and I'm just going to kind of simplify the concept. So let's say that very much like what you just described, Sean, with adding one vehicle to your fleet every year. Let's say that your business is primarily around buying residential properties and renting them out. So let's say you buy a property for $300,000. You don't pay $300 because you get a mortgage on the property. But you want to basically, kind of like the G-Wagon example, you want to get the biggest tax deduction you possibly can. So what you would do is you would say, I'm going to do a cost segregation study. And in this study, what you're basically doing is going to the house that you bought, and you're looking at every little detail. So you're looking at the doorknob, and you're looking at the door, and you're looking at the microwave, and you're looking at everything in the house, and you're saying, this is X amount of years old. I need to be able to depreciate it. So sort of like the FF&E, all you're doing is you're depreciating every micro detail of the house at an accelerated rate. So you get a mortgage, on the house. You don't have to put that much down, but maybe you'll get 100,000 write-off in the first year. Maybe it's 150. It could be quite a bit of quite a bit of a tax saving. So you don't put much down, but you get a big write-off. And what that allows you to do is to save money on taxes. So the tax code very much favors real estate investors and owners because they can take advantage of things like this. So whether it's a G-Wagon or a cost segregation study of the car, like, these things are out there and you can definitely take advantage of it if you're careful.
So this study, could you do it on your own, or are there parts of the house that have to be looked at by a professional?
Yeah, that's a great question. You can do it on your own. So one of my friends, as a matter of fact, he did it on his own. He downloaded some sort of software online. I'm not familiar with the exact name. I wish I could remember it. But basically, you just Google cost segregation study. You write down every little detail of the house, how old it is, when it was purchased originally. You try to get the historical records on every little thing. And then you give that, I think he submitted it online, and then it produced the schedule for his taxes where he could just fit that into his personal return, get a huge write-off, and be pretty happy as a result.
So it'd be cool if we could get that. But let's say somebody bought a house that's obviously 20 years old, right?
Mhm.
And they can't get those records.
Yep.
Do you then try to make a estimated age by the condition of the roof or condition of the floor?
Yeah, I think you just give a best guess estimate. You
cool.
want to make sure it's fair and that you're not trying to take too much. But if you don't have the records, you would just have to make a reasonable assumption.
Okay, and then of course you're making a good faith estimate. They might take a look at your stuff and go, "We don't agree with you." They go to the house and maybe try to disagree. But as long as you're doing it in good faith, there's no fraud or anything that you have to be worried about getting hung up on.
Yeah,
but if you're trying to make an obviously egregious cost seg, and they're like, "No, this floor is brand new," you can get in trouble for lying about it. Right?
Exactly. And I think the way to approach this really is you should know you're going to do it before you buy the property, right? So that way the buyer is encouraged, or excuse me, the seller is encouraged to be very kind of forthright and give you every little detail that you possibly can, because you're requesting that up front before you pay them. So
that's super cool. So you can stack this, right? You find a property that you're going to do forced depreciation on anyway, right?
Yep.
So you buy a house for $300,000. That $300,000 is the assumed value of said house, right?
Correct.
Right? And so whoever sold it would realize their value, but that's what the 1031 is for, if I'm correct. Right?
Yep.
So we're cool there. So then you take the $300,000 house that could be $500,000 if it was fresh. You then take your cost segregation, deduct a ton of money on this thing.
Mm-hmm.
You then reinvest in the property, force appreciation, get it refinanced, which you don't have to pay the realized gains on it because you didn't sell the home, right? So now you've realized a couple $100,000 in equity, but also took a couple $100,000 write-off or something.
Yeah.
And then you could either flip it, you can Airbnb it, you can do whatever from there. But you can actually you plan to do a cost seg on a property that you're going to do like a burr, right? And you could stack them. That's really, really cool. Because then you can take a loan against the increased value, right?
Yeah, you can refinance it. So you kind of just beat me to my next point, but that's exactly right. So you're taking advantage the year you buy it, and then you're taking advantage a few years later if you decide to refinance it whenever you can after you've made any improvements. So you're taking advantage in the front, and then you're taking advantage in the future on the backside.
Yeah. Thank you, Adult Supervision, for the reminder. I'm glad you liked that tip. Yeah, if you guys found that useful, hit the like button, because that is kind of a money hack, right? The fact that you can finance, get cash, buy a property, take a deduction, then take the cash that you the cash that you got from the last refi, you've got cash left over, and then you can force appreciation on the next property. The only real constraint for this is your ability to get the funding and the time it takes to refurbish the property and find another one to buy, right? So your constraints are really capital constraints in a lot of ways. The constraints are the labor and expertise to find the right buildings and to do the forced appreciation, because there are also people who do hard money lending too, right? And then once a property has a value, you can find a lender to give you a mortgage on it. Just whether or not they'll give you 80% loan to value is going to be based on some things about you, but you could probably still get 60% or 70% loan to value on a property, even if you have a lot of mortgages. And then I don't know if you know about this, but I know a guy who does big investing. He'll take like properties after he burrs a bunch of these, and he'll do like what's called a blanket loan. He puts them into a portfolio and does a portfolio loan against them, clearing your mortgages. So yeah, there's a lot that you can do in this world. It's really cool to think that you could do a cost segregation on a burr, just draw down and this forced appreciation on the same property, and really pull in both directions. That's nuts. Really cool.
Yeah, real estate, man. It's where the money's at.
Yeah, I love that, dude. That's really cool. So is there any closing wisdom or anything you want people to know before we adjourn this? Because I think we just slapped it with some value, and I'd like to not drone on, let people get to work on what they've learned and do their thing.
Yeah. So we just went on a little bit of a tangent, but I'm going to come right back to the basics because I think that's the most important part. And I think that's, if you remember anything from this time, I think that's the thing to remember. So number one, don't commingle your funds. Number two, own your own QuickBooks. And number three, don't be afraid to learn a little bit. Do a little research on YouTube, on ChatGPT, do whatever you need to do. But the more you know, the more dangerous you are, the better results will come your way because you'll know the right questions to ask. The last thing that I didn't mention, which I regret, I should have mentioned earlier, is to ask any question that comes to your mind to your accountant. And here's how you know if you have a great accountant or if you have a terrible accountant and you need to change accountants. If you're confused by their answer, you need a new accountant. If the answer that they're giving you, boom, you understand it immediately, you have probably a pretty good accountant. So don't settle for the stereotypical accountant that has a hard time communicating their thoughts. Go for the accountant who, when they explain things, you understand it immediately. If you don't understand it, it's not your fault. It's the accountant's fault. It's a little misconception there. So don't be afraid to ask questions, and don't be afraid to find an accountant who can answer you clearly. I think that's probably
I love that because that's actually the sign of somebody who's mastered something.
100%.
Right? A master can explain something simply. And I use that as a litmus test too. Like I do coaching every Saturday for 4 or 5 hours with my students, and they'll ask me any question under the sun. And every once in a while, I will be grasping at straws to find the words to explain a concept. I go, oh my goodness, I have somewhere to go with this. And I'll spend the next week like trying to cram like as much as I can find about that one topic. Somebody, if it's revenue management or negotiating with a landlord or market research or whatever, if I wasn't able to go, here is the answer in crayon, then I know that I'm not a valid enough coach yet in this topic, and I got to get to work. It's a really cool way to put that. Yeah. So to pop quiz because here's the thing though, like a shyster will give you a simple, confident answer for something, and it could be wrong. Right. Yeah. We see that on the internet all the time. But if they're your accountant, they better actually know accounting. So and
most accountants probably don't have the ability to kind of make up a response on the spot. Like just kind of as an industry, I don't think they're in that direction usually. But
they're not a club promoter.
Yeah, exactly. But to that point, you should also find somebody that's not scared to tell you when they don't know things. And I think that's equally as important. Because, the last thing you want to do is like ask someone a question and they give you a response and you're confused by it. But the reason you're confused by it is because they actually don't know what they're speaking about. Whereas if they just said, hey, listen, I have no idea, but I'll research it for you and I'll get you an answer as soon as I possibly can. That's the response you're looking for.
Yeah. It's good to be humble enough to know that you don't know something.
Yeah.
So I love this. This was really, really good. Well, guys, I did already put the link to his website down below. You've probably heard him say it right now. You guys really maybe don't even need an accountant initially. You need to know your own accounting well enough to know when you need an accountant. But if you guys are business owners and Bench put you out of business, or put you out of like an accounting solution, Ledge, in my opinion, he was the first person that came to my mind. As soon as I heard Bench went out of business, I'm like, I need to call Ryland, and I hit him up. I'm like, where are you? So if you had Bench, Ryland and his company Ledge is a great immediate solution to pick up the pieces where they failed you. And if you guys ever grow to a point that you need a company like Bench or Ledge, Ryland will have a link down below and you can find him and contact him when you need. But for now, I'll tell you guys, you don't need to spend money on stuff when you're new at things. So just take Ryland's advice, get your own QuickBooks account, get on ChatGPT, learn about accounting, and go as far as you can until you realize that maybe accounting is holding you back. And I made a mistake of not being self-aware in my business. And even though I did cash really well, I never raised money. I never took loans. I just always did stuff on my own. And I'm sure that like my lack of accounting practices held me back at one point in my business. So don't be as stubborn as I am. But yeah, I still succeeded without needing to spend tons of money on an accounting firm initially, at least. I mean, but now, of course, even I have help and accountants too. So, you know, you will need them one day. So, Ryland, thank you so much for your candor and your expertise and helping people understand what happened to Bench. If you showed up late, we talked about what happened to Bench in the beginning, so just hit the replay button on that. And yeah, as always, my friends, thank you, and we will see you on the other side.